Most people think Charlie Munger got rich because he was smarter than everyone else. That's wrong. He got rich because he avoided the stupid mistakes most people repeat their entire lives. No hype investments. No fast money fantasies. No shortcuts. These rules are not motivational. They're uncomfortable. They remove excuses. And they're the reason lazy thinking fails in the real world. If you're looking for easy money, this video will disappoint you. But if you want rules that actually survive recessions, bad luck, and human stupidity, stay. Busy. Arete 10. Brutally honest money rules. Charlie Munger lived by. Rule number 1. Avoid stupidity before seeking brilliance. Charlie Munger believed not losing money was more important than chasing big wins. He called it avoiding stupidity instead of trying to be smart. In real life, this means not touching things you don't fully understand. No leverage you can't control. No businesses you can't explain to a teenager. No investments that only work if everything goes perfectly. A real example is the average retail investor using margin in 2021. Stocks went up, confidence went up, risk was ignored. When rates rose and markets dropped, margin calls destroyed years of savings. Not because they were unlucky, because they were stupid with risk. Munger avoided this by staying inside his circle of competence. Coca sees candies. Simple businesses with predictable demand. No hype. No leverage. No financial gymnastics. How to test this rule in your life? List every financial decision you've made in the last 3 years. Ask one question. What could have permanently ruined me here? If the downside was life-changing, you violated the rule. If the worst case was inconvenience, you were probably safe. This rule alone keeps most people from financial disaster. Rule number 2. Invert. Always invert. Ask how you fail first. Munger didn't start by asking, "How do I get rich?" He asked, "How do people go broke?" Then he avoided those behaviors aggressively. Going broke usually comes from debt, ego, impatience, and complexity, not bad luck. A real-world example is lifestyle inflation. Someone earns $80,000 and upgrades everything immediately. Bigger apartment, new car payment, expensive subscriptions, income rises, but margin disappears. Then one layoff, illness, or market downturn breaks everything. Munger structured his life so failure was hard. Low fixed costs, minimal debt, long time horizons. How to test this rule in your life? Write down the top 5 ways your finances could collapse. Job loss, health expense, market crash, family emergency, bad business decision. Now ask, which of these would wipe me out today? If more than one does, your system is fragile. Munger designed systems that survive stress. Most people design systems that only work in perfect conditions. Inversion forces humility. It removes fantasy from money decisions. It turns finance into risk management, not hope management. These first 2 rules aren't exciting. They won't make you feel smart, but they quietly remove the biggest reasons people fail. Rule number 3. Only play games where you have an edge. Charlie Munger never believed in competing everywhere. He believed in waiting. Most people lose money because they force action. They trade because markets are open. They invest because others are making money. Munger did the opposite. He sat on cash for years when nothing made sense. A real-life example is day trading. Millions participate. A tiny percentage win consistently. The rest provide liquidity. That's not a fair game. Munger avoided games where skill couldn't dominate luck. He preferred businesses with durable advantages. Brand loyalty, pricing power, regulation barriers, simple economics. How to test this rule in your life? Ask yourself where you genuinely have an advantage, information others don't have. Patience others lack, cost structure others can't match. If you can't name your edge, you don't have one. That means you're gambling, not investing. Munger waited until odds were clearly in his favor. Most people mistake activity for intelligence. Rule number 4. Big money is made by sitting, not trading. Munger hated unnecessary action. He believed compounding required time, not constant decisions. The human brain wants stimulation. Markets reward boredom. A real example is the investor who bought an S&P 500 index fund in 2009. Did nothing for 15 years. Ignored crashes, headlines, and predictions. That investor beat most active managers. Not because they were smarter. Because they stayed put. Meanwhile, active traders paid taxes, fees, and emotional mistakes. Munger described investing as watching paint dry. He meant it literally. How to test this rule in your life? Review your last 20 financial actions. How many improved long-term results? How many were emotional reactions? If frequent action didn't add measurable value, it was harmful. Time is the unfair advantage most people refuse to use. They want returns now. Munger wanted certainty. Later, he understood that doing nothing is often the hardest discipline, especially in a world addicted to movement. Rules 3 and 4 separate professionals from amateurs. Professionals wait for advantage. Amateurs need constant engagement. Rule number 5. Incentives control behavior more than intelligence. Charlie Munger said, "Show me the incentive and I'll show you the outcome." He believed most bad decisions weren't caused by stupidity. They were caused by misaligned rewards. A real-life example is financial advisors paid by commission. They don't wake up thinking about hurting clients. They wake up thinking about hitting targets. So products get sold, not chosen. Complex funds, high fees, unnecessary churn. Munger avoided situations where incentives worked against him. He distrusted advice from anyone who earned more if he acted quickly. How to test this rule in your life? Look at every person influencing your money decisions. Employer, bank, advisor, partner. Ask one question. How do they win if I lose? If their upside increases when you take risk, be cautious. Munger structured his life to avoid incentive traps. He partnered with people who thought long term. He paid for advice, not persuasion. Most people ignore incentives and blame outcomes. Munger blamed incentives first. Rule number 6. Compounding requires discipline, not genius. Munger never chased extraordinary returns. He chased consistency. A steady 12 to 15% over decades beats bursts of brilliance. A real example is to investors starting with $50,000. One tries to double money quickly, takes big risks, blows up twice in 20 years. The other compounds at 12% with no disasters. After 30 years, the second investor wins massively, not because of skill, because they survive. Munger understood that avoiding ruin is the real secret. Compounding stops the moment you blow up. How to test this rule in your life? Calculate your realistic long-term return. Subtract taxes, fees, and mistakes. If your plan depends on extraordinary outcomes, it's fragile. Munger built systems that worked even when he was wrong. He accepted average returns with extraordinary patience. Most people want extraordinary returns with average discipline. That mismatch kills compounding. Rules 5 and 6 expose why intelligence doesn't equal wealth. Behavior. Structure tasks. Time. Dose. Rule number 7. Complexity is the enemy of execution. Charlie Munger had deep respect for simplicity. Not because he couldn't handle complexity, because he knew most people couldn't execute it. Complex systems break under stress. Simple systems survive. A real-life example is the average investor portfolio. Dozens of stocks, multiple funds, crypto options, foreign exposure. They don't understand. When markets fall, confusion replaces logic. Selling decisions become emotional. Munger avoided this by owning fewer, better ideas. He believed concentration increased understanding. Understanding increased conviction. Conviction reduced panic. How to test this rule in your life? Try explaining your entire financial setup in under 2 minutes. If you can't, it's too complex. If you don't understand how money flows, risk hides there. Munger's wealth came from clarity, not diversification for comfort. Most people confuse complexity with sophistication. Rule number 8. Patience beats intelligence in the long run. Munger believed the world rewards people who can wait. Not the smartest, not the fastest, the most patient. A real-world example is career compounding. Someone who stays in one field for 20 years, builds rare skills, develops reputation, understands the game deeply. They outperform job hoppers chasing short-term pay bumps. Munger waited decades for results. His biggest wealth came after age 60. Patience allowed opportunities to come to him. How to test this rule in your life? Look at where impatience has cost you money. Selling too early. Quitting too soon. Switching strategies mid-cycle. If time would have fixed the problem, impatience caused the loss. Munger accepted boredom as the price of long-term success. Most people reject boredom and pay for it financially. Rule 7 and 8 separates calm builders from restless destroyers. The market transfers money from the impatient to the patient. Rule #9. Reputation is worth more than money. Charlie Munger believed reputation took decades to build and seconds to destroy. He treated trust as a non-renewable asset. Short-term gains weren't worth long-term damage. A real-life example is corporate leadership scandals. Executives cut corners to hit quarterly targets. Stock price jumps briefly, then lawsuits, fines, and reputational collapse follow. The money disappears. The damage remains. Munger avoided partners who chased fast wins. He preferred people who thought in decades. How to test this rule in your life? Ask yourself if today's decision would embarrass you in 10 years. If it would, it's already too expensive. Reputation compounds quietly. It lowers friction. It attracts opportunities. It protects you when things go wrong. Munger understood that money flows toward trust over time. Rule number 10. You don't have to be extraordinary, just rational. Munger rejected the idea that success requires brilliance. He believed most people fail because they act irrationally under pressure, fear, greed, ego, Envy. A real-world example is market bubbles. People know prices are insane. They buy anyway because everyone else is winning. Munger stayed rational when it felt uncomfortable. He accepted looking wrong temporarily to be right long-term. How to test his rule in your life? Track decisions you regret most. They rarely came from lack of knowledge. They came from emotional pressure. If you remove emotional decisions, results improve automatically. Munger didn't try to outsmart others. He tried not to fool himself. That alone put him ahead of most people. These last two rules are the hardest because they require restraint, not action. Integrity, not cleverness. Rationality, not excitement. Together, all 10 rules form one idea. Wealth is built by avoiding obvious mistakes repeatedly, not by chasing extraordinary outcomes.